Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge in Chicago, bringing you our strategy of the week update here for June 23rd, 2022. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion, not a direct trade recommendation. Holy cow, what a bloodbath we saw today in the agricultural futures. Really, I think we're starting to see not only the highs and seasonality of a high being in place in the June to July timeframe, certainly being the case here from what we've seen, but not really being confirmed by the spread markets. We'll look at July, December, that old crop, new crop spread here in a second. For corn, which just went through the roof the last couple days. I'm just as shocked as anyone else to see that bull spreading on red days here for the last week. And it wasn't just today, it was the last like whole week, 2 weeks of price action that was being bull spread while we were getting hammered in the outrights. So commercial buying interest there. Trying to gobble up what they can in July, offsetting that risk by selling December. Um, Seems to be the name of the case. And okay, that might be a show. The fact that there is not much more corn out there across the country to get out of the bins for July and for that old crop. And we might be just left with new crop production, and we're hoping to utilize the board price to meet help ends meet, make ends meet between then and now. And that's kind of the commercial way of thinking about it. With all that being said, we've seen some pretty heavy price action. We're going to begin with crude oil today, because the crude complex breaking down. Actually, before we even get into crude, let's look at RBOB, because gasoline price is coming off of a high of 430 here. Good to see a top in RBOB start to form. I think that this is one of those things that uh, it's hard unless you are a gasoline, refiner, a crude oil refiner. It's hard to say that you're you're not happy about RBOB prices falling back below 4 here in the last couple of days. We have pulled back into a 50% retracement from that 280 up to 430 highs. So gas prices coming down a little bit over the last couple of weeks. Maybe we're finding that summertime top. If until we break below 340 here and back into this old range that we were in between 340 and $3, we could still be just finding a short-term pullback in an otherwise upward trending market. There's certainly a channel to be talked about here. There's a reason that the trend might still be up on the daily time frame when you look at the step back from go back a couple of years here in RBOB. But it's also I think hard to imagine us going much higher this time of year when seasonally this is when we peak out on gasoline prices and all those good things. So watch out for like head and shoulders pattern to form. I wouldn't be surprised to see a rally back up to kind of close a gap here around 380, maybe back up to $4 before rolling back over. But again, kind of line in the sand here between 350 to 340. Below those levels, back down towards 3. I think it's safe to say that we're finding a high in gasoline prices in the near term, right? I'm not talking about uh, anything more than just the next couple months or maybe even weeks, the way these markets are trading. Crude oil reversing heavily after breaking its channel that we were holding here for the last several 2 months or so. It was a pretty choppy price action up, but we did press above that 115 area that was kind of resistance. That kind of definitely was resistance in what was a range. Broke up towards 120, 125. I thought that was the case, or the move that was going to then take us higher, and crude just retraces back in this range. It's hard with crude oil and the amount of intervention that's going on globally. You've got the U.S. continually rocking out there and selling that strategic petroleum reserve. I think that's a silly move at these prices because it's almost inevitable what inflation and energy prices are going to do on without opening up more drilling and really and honestly, I think the biggest issue with domestic and U.S. oil prices right now is the fact that we have switched to from being a net oil importer to an oil exporter. We went from the idea of energy independence sounds nice on paper, but when it forces you to only use your own crude oil, which then is in constant competition with our export markets, we see the type of price action that we've got over the last several years. It ends up becoming a honestly kind of a darn bad situation for the domestic user. Even though our oil companies are perfectly happy to become now net exporters and And it's not necessarily a bad thing for the US dollar. So, hopping over to the US dollar real quickly, the Dixie has been incredibly strong. We'll come back to crude in a minute, but I wanted to show how uh, on the US dollar, I think it's really important to go to the out to a continuous contract here to kind of see how far we've come, and how we are now breaking above the pandemic highs. So, from a longer term perspective, this could be, this could kind of be a, the market finding some kind of top for the dollar just because of the last, and honestly, kind of need to go out to let's go the monthly nearest contract here so you can see, these are levels, this 100 level over the last almost decade, we really haven't been above. In fact, yeah, we got to go back to 2001 through 2004 to even see the Dixie back up into these levels. I'm not saying we can't go there, but we've come a long way, and without much of a pullback in the dollar, currencies oftentimes do have these very extraneous trends in them, but I don't believe we're in the type of environment with the Fed just starting to hike rates, coupled with the fact that the bond market has been so strong lately, and found, since the last FOMC meeting, has seen quite a risk reversal in that um, hawkish kind of mentality. There's short covering going on in the bonds. That should be weighing on the U.S. dollar right now, and each push above old highs here has found resistance and eventually pulled back. It's also worth noting that the 50% retracement, for this entire decline at this point, is trading. We are up into that 50 to 61.8 level. Reverse these. I drew that fib up backwards. I can never keep straight which in these two platforms I'm using. Let's just delete that and redraw it real quick. Of where to start the fib sometimes. So there you go. So we're up into the 50% retracement, 101, 107, 109.8 area is the 61.8 line of that entire rally. But you can see, going back to the early 90s, we really haven't, and back to the pre-2000 era, we really haven't been above this 105 to 107 area. We're at the highest levels in the dollar in almost 20 years, and that's something to kind of consider. And if this dollar strength continues, which it certainly can, it's going to have to be met with, I think, a bond market falling and some other things going on. Now, I don't think the dollar strength at this point is going to weigh on commodity prices too bad, because I think a lot of this dollar strength is foreign purchasing to buy U.S. commodities at the end of the day. So we've seen, crude oil strength alongside dollar strength this year. That's a flight to quality in in an inflationary type move. Inflation doesn't mean necessarily that the U.S. dollar as an index or the dollar against other currencies is going to sell off, right? Inflation is the dollar's value against commodities, stocks, and non-fiat currencies at the end of the day, because fiat currencies will always have a race to the bottom, and it's just a game of central banks leaning on each other for those carry trades. In other words, who's going to have the low interest rate for a while, attract more purchasing of their currency to be then lent out where there will be higher currencies. In other words, say you see currency flow to areas, right, of from low interest rates around the world to areas of high interest rate. Okay, so just wanted to kind of touch base on the dollar index there. We are kind of coiling here over the last few days. Unless we break out above 105 and towards 106, and again head towards that 61.8 line up around 108, back below 103, the 18-day moving average tested the 55-day around 102, 100 days down around 100, and 200-day down around 97. So we could certainly see this coiling here in the dollar index go either way, but it's want to call it to people's attention here that, okay, maybe we've run the course with the dollar index and it could be looking to do something here, move soon. So back to crude oil for a quick second. This to me does look like solid three-wave structure. A maybe down, B in some choppy price action, and this is maybe the C leg lower. We could be setting up in some kind of triangle or sideways price action still. So that needs to be considered, that this could all be very much sideways in a range still until it's not. But if we do see some continuation lower, Look up for that 618 line down around 88.50 to 86 bucks. If we break below this trend line at 100 here, and don't coil basically in sideways price action, three legs down towards 86, and to test this old trend line is probably, in my opinion, where we're going. The full 50% retracement, though, from the continuous contract lows of 650 up to the 129.97 highs here would be a pullback all the way towards 70. I'd way too soon to be talking about getting there. Considering we still have a trend line here and maybe a bit of a choppy range to fight through. In the near term, however, on the crude, we are seeing some technical selling here off the highs, and there is a bit of a trend to follow. Full 50% retracement here from 123s down to 110s. Okay, it was a little bit of a front run of 117, but what's a few $100 between friends on a market that moves $5 at a time. $5,000 in a clip. Next in the series, when it went from entry highs down to its negative 23% target. Next in the series here, from highs to lows, kind of traded around that 111 area. Went down to its targets. Now, next in the series, from this 111 high down to the new lows, we have the market trading its third in the series down here in a pretty distinct channel, and a break above 108s. That's what would constitute me wanting to be a buyer, right? We break above 108, and then I would be looking to buy the 50% dip off the lows, and we'll see. We would see where the market could take us from there. Okay, so certainly, full 50% short off the highs. We got to consider around 112 if it pops up there too. But if we do break, this downward sloping trend line here in the crude, coupled with a move above 108, I think being a buyer in the dip is probably a decent idea for a move back towards 120 and maybe the breakout higher. Because if we do break out of this range, heading up to 150 to 160 to new all-time highs for crude, probably on the table in my opinion. All right, let's switch over to our agricultural products now, because I think this drop in energy prices has filtered over into those ag products, particularly with corn and soybeans recently. Soy oil was the big loser here as of late. Let me just throw that up on a chart real quick. We'll just look at July contract here. This July contract of the soy oil absolutely collapsing. We had a full 50% retracement long, kind of traded in three waves down. It got a reaction, and without breaking the 618 line and giving me what I would call an ambush short setup. In other words, if we had traded down below 75 and then traded up in this leg, into a 50%, I think it would have been a much clearer sell. But the 50% off the highs here, it held at 618 line, and has now not only broken down to beyond its 74 target, but down towards the 69.70 target. So next in the series for soy oil lower, I'm drawing from 76.60 down to new lows. That low to low extended short now. I see resistance around 72. And lo and behold, if there's kind of a neckline that might form here around 69, a little bounce back towards 72 to 74 kind of makes sense, and making a mimicry of this left shoulder. But this huge breakdown in soy oil, we do need to realize that from the 51 lows up to the 87 highs, we are dipping below the 50% line around 69. So there's definitely a downtrend to be considering here. And this massive sell-off we've seen has, I think, been a response to, a drop in diesel prices, drop in crude here recently, more recently than not, but really has been started from the massive sell-off we've seen in palm oil and other veg oils globally. And now that's starting to weigh on the bean complex as well here. So soy oil absolutely getting obliterated. I'm not so certain we'll find a low in beans until we get a bottom in this chart, which, stepping out to a daily time frame, we got a long ways to go back down to the lows, that we kind of consolidated against from last year around 50. And that's something to, kind of consider. The old highs that we broke out from for the soy oil were around the 59 or 60 to 63 area. So very well could be heading down there in the near term. Something to keep our eye on, as of late. So let's flip over now and take a look at the daily chart here for July beans. Um, I was actually hoping that this 100-day moving average here yesterday was going to hold. Once we got below that 55-day, it was pretty much a sure thing to hit to the 100-day. But kind of a nasty, sell-off and panic selling now that's happened under this 100-day moving average and taking us right back down to the low end of the range. All you can really say about this chart technically is we had a false break of the highs and fell right back into the range and have now traded this entire range back down to its low. We talked about last week that this is very much a possibility, and well, now it's not only a possibility, it's the reality of the market. We are very oversold, obviously, on the daily stochastics here. So retracing from overbought to oversold in just like 2-3 days time. Kind of an impressive reversal there. But again, coming back to maybe some hope for this chart is that it's still a range until it's not, and we are getting closer and closer to the low end of that range. I do think this market's going to want to run below these old levels just because it can, and to cause as much pain as it can to as many people as it can at this point, and everyone that was buying on this way up. But I do think it's safe to say that a top is in here before we get into new crop contracts. That's almost an understatement. Yeah, I don't know what could happen over the next couple weeks weather-wise. We've got rain in the forecast here each weekend, which is going to be, very helpful to the crop, given that we've been dry and hot here to start to, put a little stress on early. But the fact that we're getting mild, coming into some mild temperatures, mild, still high 80s, but low, 60s overnight, with generally rain here each weekend, this weekend and next. In the forecast, that is definitely pretty ideal in terms of conditions for growing right now. The eastern belt is not as benefited to that rain as the western belts are, but we don't really have room for weather issues, which this, I guess we needed to take weather premium out of the chart here. But it doesn't change the fact that balance sheets are what they are. Without damn near perfect yields and production, we're still going to run out of corn and potentially beans this year. That reality will set back in here, and I think we have a case, on a little bit of a longer time frame here, but the further you pull back that rubber band, the further it can fly here. So, soybeans selling off very hard and fast just is going to give commercial interests and those that need to own beans more of an opportunity to start buying. And then when our export market starts to take back over, and maybe if the dollar falls a little bit to help those markets, we could actually, see some. We could see a true change to the dynamic that we're kind of seeing play out here as of late, which has been just panic selling. There's no other way to describe this here as of late. So again, we'll take a look at some of the smaller time frame levels in a minute. November beans back down in their range. 1400 is obviously a supportive area to be interested in. The 200-day moving average is still below us around 1370. But there's kind of a trend line here on the chart that comes in around that 200-day and maybe could see us test down towards 13 bucks. At this point in time, we cannot rule out the idea that beans in the teens as a psychological factor might get tested for Novi beans. And that's just part of the reality of what we're seeing. Some of the stranger price action of this week was in spread markets. We're still continuing to bull spread our old crop, new crop spreads. July Nov beans, not to the extent that corn is being bull spread right now, but got a reaction here from the full 50% retracement back around that $1.60 area. Clearly a supportive area for this spread. Heading back up towards $1.92 is just this spread bouncing around and doing what it's doing. It's interesting though that every other test of the low of the range, end of the range on soybeans, if I pull up look at the small chart of July on the right-hand side there, every one of these tests down was also met with, bear spreading here until this sell-off. This sell-off has not. In fact, if we overlay real quick, add study, compare with, Um, just compare it with that front month bean. There it is. We've been bull spreading while we've been selling off in the futures. So go figure. We've completely decoupled from the spread. I think this is pretty much end of month, end of quarter type price action for those spreads, and certainly commercial interest coming in here and saying, well, if I'm going to buy November, July beans in this type of environment, I better be laying off my risk by selling new crop. And the same could be said for corn. Actually, even more so for corn, which we'll look at here in just a minute. But in soybeans, that July contract, working down to the smaller time frames here, full 50% of our last swing, from the $12 lows from November, basically lows of the year to highs here, contract highs at 1786. That comes around 15 bucks. So yeah, I definitely think we could get down there. This looks like some kind of maybe expanding triangle type structure with an A, then a B, either here or here, probably here, and then a C, big D wave, and then a very large E wave on its way down would probably push below 1550, if you want to call it something an LA wave, but it's a range until it's not. And certainly because we pressed above the high end of the range, the market is going to cause pain here, and I think press below the low end of the range. Basically, run stops on both sides of the market for what feels like almost no reason. But this is futures doing what futures do. They are, technically paper markets until we get into delivery, which yes was rapidly approaching here for July. But after first notice, July might snap back a dollar. We don't know exactly how this will behave. But this is the last time we're probably going to be looking at July. We're going to move towards that August contract here next week, and of course, be talking a lot more about the November. In the near term here, though, let's go down to an hourly chart. We did go up and fill that gap here on soybeans, at least in the July contract. We did not in November. That gap is right here around 1702. The sell-off has actually been fairly technical. Certainly since the start of this last week, we had a 50% short off the highs. That traded down to lows. We then started thinking about lows to lows extensions, which basically were very tight, but there were a couple that traded here intraday, and then the new low to low here held, I guess, today. But really, once we got below 1660 on this chart, which it was, if you remember, that full 50% retracement, well, I was drawing it from here, the April lows to the highs after, that 1670 to 1640 area. Once we got below that threshold here on this chart, the market started, I think, just panic selling. Once we got down to the 1650 area, the last 2 days of selling is just panic. And this is price actions designed to suck producers selling in to try to just get as much of as much of that panic selling as we can out of the charts. All right, switching over to November here. Again, breaking below this trend line support, not a great look. Pretty much, to me says that we're probably heading down to find a test, of 14 bucks, maybe even a little below. 14 to 1366 is where the 40-cent range of it's a landing zone. Can't discount these old highs around $13 if it gets down there. And of course, drawing from kind of our 840 lows through the lows of into the end of last year brings us up a trend line around 1350. So yeah, I think we still have a little bit lower to go here for the November bean, but there is some hope on this chart, and a reason that I don't think the highs are in for November beans. This open gap up here around 1536. That's a pretty important level that I think we need to be aware of and remember is on the chart here in the near term. I certainly will be paying attention to it myself, because I think it's the type of level, or it is a level that I think eventually will trade again, and a reason we could see November highs more around $17 at some point. We trade all the way down to 1340 or 1360 to 1350. Find this trend line support. Find the 200-day moving average. Remember that's down there as well at 1369, and then maybe find a bounce, back to start some kind of trend and rally higher. Um, but in the near term, right, that's only 3 days away. Um, I think that gap will eventually fill. Going down to a 15-minute time frame here, pretty hard to find levels that you'd want to buy in the near term. But again, I think we have basically panic selling here in the soybeans. Same anchor, new low, resistance around 1440 at this time. Actually, we kind of went out the day in a new anchor to low anchor. So first break here for the beans. If we break higher, I want to see them above 1425, and then they've got to get above 1450 here for November bean for me to really feel comfortable that this sell-off isn't still in place. Off the highs here at 1584, we held a big 50% short. That short went after going to target, it went to its secondary target and has blown down. So there is a big swing, extension short here from 1515 down to the lows that we need to be aware of at this time. And that resistance is around 1460. So 1420, 1440, and 1460 are our three resistance levels for Novi beans if we get a bounce around this level. And again, if those levels any one of those levels hold, they would be continuation, could continue us lower towards that 1366. All right, we got to keep moving here. Corn, because we a lot to talked about here. Let's talk about the daily chart of corn real quick. Looks a lot better than the beans, right? We haven't had the panic selling in terms of breaking, lower below, old lows. We're certainly maybe setting up in some kind of larger range here. And that's something to be aware of. We failed to break above that 55-day moving average, quickly fell back below that 18-day moving average here for July corn. And we have a 100-day moving average getting the reaction of the day here from 736, an impressive bounce so far for the market. Yeah, 200-day moving average around 655. Also, these old highs from June and through August of last year certainly could be a level that we're going to go down and test, but I don't think the July contract has that much time left on it to do so. December getting really, really beat up. This is where the panic selling arguably has occurred. We've pulled back now into that 650 area. That's an inflection zone that we held as resistance, held as support, and now we're retesting it. Big three-wave swing lower. I don't hate the fact that we traded down here, and I do think that there's a good chance. There is a good chance here. I think that December corn might have found a low today. I wouldn't call this the low just yet, but I think there's definitely some technicals and reasons for that. This old inflection zone being one of them. I would have loved to have seen the 100-day or 200-day moving average here as well to give you a little more confluence, but we are oversold on the daily RSI. And the big kicker in the hole for corn right now that just makes this sell-off seem so strange is the spread. Old crop, new crop spread. You can see here today we were down only 21 cents in July, down 38 cents here in December. Pulling up a chart here of our old crop, new crop spread. I'm going to move today's price action kind of off of it and just remind us of what we were talking about last week. A market that was basically breaking up towards 60. Talks about if it goes through 60, it could head towards 70, and then above 70 back towards $1. Okay, only took 3 days to do it. But the bull spreading we've seen in July beans, or December beans, excuse me, corn. What am I saying? July D's corn has been absolutely aggressive and really, really impressive. And is maybe a canary in the coal mine that says that, hey, corn might be done going down. Because you overlay this chart, you quickly add the study to compare with here, just outright corn. which would be July corn at this point, you can see how we were generally trending somewhat together here through the start of this year. And there have been a couple decouplings of the spread. One happened last in April, where the outrights continued higher, and then but we were kind of bear spreading against it. Well, then they kind of converged on each other, didn't it? The spread came up, and the outrights came down. Then we found a period where we were in a little bit more lockstep with the outright and the spread. They were kind of trending together, right? And then we've now entered a period where they've completely decoupled the last few days, with the outrights selling off massively from last Monday, and the spread market basically being bull spread. And this is definitely where I think we've seen commercial interests that are saying, hey, I'm buying July on the way down. I need this corn now, but they're not willing to just buy July. They're offsetting their risk by selling that new crop as well. And doing it very aggressively. You probably, if you looked at option markets, I bet we would find the same kind of dynamic going on there. Lots of put buying alongside long futures or what have you. People are being very protective of the trades that they're putting on. At least the big spreaders and big traders are. But trading up to 97 cents over is pretty darn impressive here this week for this spread. I would imagine we're going to see a move back down towards 70 cents over, because this is just a little too far too fast. But if we do see that pullback, I don't think we're going to see it correlate with downside in the outright markets. I think we're going to see, just like that period in April, some convergence back in the trend back towards kind of each other. So maybe a reason that today's lows might stick and be something to talk about for corn. We'll certainly take a look at that here in a second. All right, so moving down to the smaller time frame here, the swing from 643 up to the 824 highs, we're just retested that 735 low. Kind of got a trend line here against the lows that bounced here today. So as long as corn stays above 740 here for the what's it called? Sorry, kind of losing my track of mind here. So long as we stay above this area, 735 to 740 in July corn, that could be a low forming, and we might just be, setting up in kind of an end of life type of wedge here into the end of July, which then, puts us into the September contract, gets us into that new crop time frame. And then we're really talking weather markets. And at that point in time, obviously, when we take a look here at the chart of July here in a minute, December here in a minute, you're going to see what I mean. Open gap up here on the July corn at 782. I believe there's one on December corn we'll look at here in a minute as well. But again, more hope that we could get back up to those levels and fill those gaps eventually. But it might take into August and September to do so, and certainly the heat and weather markets of July to help with that. Okay, so looking at December corn, basically a full 50% retracement for the year. So from the January lows through the highs, that's where the 650 level comes from. There's certainly this inflection zone that we been talking about for a while, and it's finally come back down, to it. The old high, we broke above it, came back down to test it, and it's right here around 640 to 650. And sure enough, we've traded that. Old trend lines against the lows are down around $6, and we know for December corn, 610 is that 200-day moving average below us, and the full 50% swing for the entire contract from low to high ends up coming in around 657. I'm not saying or 567. I'm not saying we're going there, but something to consider and think about if the market decides to continue to be really heavy and head lower in the near term. Got to be aware of that here going forward. Okay, so 3 waves down off the highs. This could be a completed correction for December corn. I'm not willing to call the low just yet. And going down to like a 15-minute chart here. Again, we've got that open gap to consider and to remember up here around 730, let's call it. Okay. We have to remember that that level exists and could certainly be a reason we head all the way back up there. Um, we've been in a sell-off here with a pretty clear trend line against the highs. Kind of a couple trend lines, perhaps. Uh, no studies drawings. Give me my fib tool. We did hold what I would call 50% retracements from our gap down. Went, basically stayed below 707 there. Went down to targets, to the secondary targets. Maybe started a new little extended short from low to low here. That little extended short has aggressively blown through its target, so now a new low to low. And today we traded up into that 618 line. So a push above 660 here again, and might give you a reason to be a little bit of a buyer on a pullback. That's something to watch and to consider for. And again, kind of that smaller time frame that reversal that I would look for to maybe think about getting long December corn. My only issue is, of course, with how we've been bull spreading that July-December contract. But at the end of the day, I think that that will kind of reverse here in the near term. All right, so moving on to wheat. On the daily time frame, we've basically unwound the Ukrainian news spike and Russian war kind of news here. So July wheat heading down below 950 and towards $9 and maybe even eight, and that 200-day moving average around 898. Those are levels to me that suggest the market is in fact the market is in fact give me 1 second here, everyone. Those are levels to me that suggest the market is in fact just unwinding that news cycle. We've put in a double top in the 1300. Could we get through that up into those levels again? Yeah, sure. But we're unwinding, this entire rally at this point. Certainly looks corrective to the downside, maybe A, B, and then this is a strong C leg. Could we be getting close to that support? Well, we'll take a look at the smaller time frame in a minute, and I guess I could throw up a fib retracement here, basically from the $5 level up and two through highs. That 50% retracement is right at that 200-day here at $9. So testing $9 here, I think for Chicago wheat is probably in the works. We'll see what happens. Holding above $10 here for the KC wheat, I think that's just because of the protein premium that we see there. And I do think this is more of an expanding flat. So this would have been an A down, B up, and this is C leg, which needs to go below $10. 929 is its 200-day moving average. I think we're probably heading down there in the near term before we find a low. Not willing to sit here and catch a falling knife in the wheat complex right now because it's just we're unwinding crazy wartime news spike that makes things difficult. All right, so we've come down now. Last week we were holding above the 1030 figure. We came down and filled that gap around 1014. We got no reaction again here at $10 for Chicago wheat, and have head down to that 61.8 line of the 733 swing up to highs. So yeah, we're starting to get down to kind of the more extreme levels that you would expect this market to kind of press down to. But nevertheless, I think it might have a little bit lower to go, and we're certainly holding a series of shorts up the highs, the last of which we talked about last week, 1098. We need to see a move above $11 and 1120 to start being a buyer again. That never happened. This coiling and sideways price action we saw, market broke down instead, headed to 993 low targets, and now towards the secondary target around 938. So low to low extension here and the new fib pull that I'm looking at and tracking. Resistance now for Chicago wheat up towards 980 to 990, and we would need to break back above $10 to maybe even be considered a buyer at this point. We'll continue to track that here into next week and see if there's something to do there, but no, I wouldn't catch a falling knife in the wheat just yet. All right, now looking at some of our outside markets, the E-mini S&P got a little bit lower than I thought. We had every opportunity here for the market to hold support this coiling to break out and head above this 50% short next in the series short that traded. You can see here from 4,200 now we're heading down towards that 3,600 area. Okay, maybe that's traded to target. I'm just going to remove from the chart to take away some of our fibs. There's definitely some fibs here that we can look at in the small time frame, but the market's probably in a rally back to fill a gap here around 3,900. 39.22 is the 50% short from that 42.02 high down to the low, and that area would then have a downside target towards 3,500, which is the full 50% retracement from 2,100 millennial Black Monday lows. These were the lows, of course, from the pandemic, and then the Fed bid. I don't even know what we call this, but the run up then to new all-time highs. So we've now pulled 50% retracement into that 3,500 area. Interesting to me. We'll see how this happens. This is, 1, 2, 3, 4. I would constitute this as 5. This would be this upswing up in 6, and then one more swing lower in 7. 3, 7, and 11 are the corrective wave structures and Elliott wave you look for. So we need another bounce and a sell-off down to that low to complete a 7-wave correction here. If we do hold around 3,500, certainly above 3,200, next swing up would be towards 5,500. So get those 401ks, IRAs, and long-term stock holding plans ready because we might have another leg lower. But I think it would be the opportunity to pick up some low-hanging fruit and the names and the things you like for the longer term if you're not just an indice buyer, as I'm kind of talking about here. 30-year, actually I got the 10-year up here that has traded an impressive recovery, but the 30-year I think is even more impressive right now. You go, September bonds right now, channeling lower for sure. We're starting to bounce in this channel. Old resistance and old highs here, 143, 142. I think we could easily get back up towards that 140 to 139 area. The bonds are holding an extended short from, if my memory serves, from a low to low. That's 1, 2, same anchor, new low here. Yeah, it would have resistance between 138 to 140 on this bounce and this recovery. I do think this is a bit of a dead cat bounce because in the rate rising environment we have, it's kind of limited upside of what we could see, but we can't discount that if they really wanted to rally this back, the next in the series 50% short, or 148s would be the next big resistance above 140 if it does some kind of multi-month short cover here before we get into Jackson Hole meeting there in August and into September, and of course the December rate meeting where December is one of the most, at least in the last 10 years, has been a very favored time for the Fed to act. At least it was during the Bernanke era and into the early Powell era. They were removing quantitative easing during that meeting just to begin this entire reversal that we've seen in interest rates that really began back in 10 years ago in 2012, but we had to, before interest rates could really go up, and that's certainly that first little taper tantrum we saw in the mid 20 teens, we had to reduce the quantitative easing and the POMOs and the purchasing of the Fed. So that got walked back on for the first half of the decade, and now the second half of the decade they started working in rate rising, and now we are truly into an inflationary cycle where rates are rising and going higher. That's why there's been strength in the US dollar and a collapse in our bond pricing because interest rates are going up. Anything else I want to cover here? Cattle have been absolutely sideways in both the feeders and the fats. The August feeders here, a bit of a leader to the upside. The full 50% short we talked about last week and the 50% long, well, the longs are winning right now. There's no little short there. However, when you take a step back, there's still the 50% short off the highs from 187 down to 162, and the 50% long from 162 up to the highs. So battle of the trend still happening here, but they're putting pressure on the shorts. A break above 175 and certainly 178 would constitute a reversal for that trend at this time. And the fat cattle here, very sideways, very choppy, all inside price action from the last few days. 6-18 line break of the long off the low we talked about last week. 6-18 line break of the short off the highs. That's keeping and calling in question this sideways price action I talked about last week. That was very probable that could occur. And sure enough, that's exactly what's happening. We're just bouncing sideways between these levels. We're coiling up for a move one way or the other. Below 130, we break down maybe a head and shoulders pattern here with the neckline at 130. It could break down towards 118. Above, 137, 140, we're heading up to new contract highs towards the 150 area. And something to consider there for our cattle markets. I think we've covered just about everything here from that we could talk about. Energies, equities. I didn't go over the metals, but I haven't covered those in a long time. Maybe we'll get into those a little bit next week. But I don't see much in the way of trades you need to run out and take right now in this volatility. I think in row crops and the grains, we're searching for a bottom on the charts. And certainly from a fundamental standpoint, we're getting probably close to one. We see the commercials using spread markets a lot more here to offset risk and to minimize, right, the buying they need to do, the impact of the buying they need to do in a bearish market. Equity indices are probably still heading a little lower, but maybe have a higher to go in the next couple of days before turning back over towards 3,500. We'll be watching that. Cattle going very sideways, and energy products kind of mixed at this time, with crude oil hunting out a low for itself. So that being said, everybody, thanks for joining me this week. I can always be reached over here at Zaner at 312-277-0110. You can find me on Twitter and Facebook, or shoot me an email, dhussey@zaner.com. Before we go, I do want to highlight and ask any producers out there, come and check out the Zaner Ag Hedge Farm View app. This is a new tool we've produced for our producers and hedgers to be able to track your on-farm production at every level. It begins by entering field data to where you can, log back in here, entering field data to where you can track your production down from the point of origin, inputting your expenses from cash, rent, fertilizer, seed, and pesticide costs, and then adding in your sales plan where you can track all of your forwards, futures, the hedges you have put on, and track them all down to the very penny. And at the end of the day, build out reports here, for whether it be field reports, total farm P&L, or even profit and loss matrices to figure out where your break evens are. Totally free to use. Of course, we'd love to be your hedging provider. Is the goal from our perspective, but the FarmView app here, there'll be links in the comment section and everything below to get set up here if that's something you're interested in. So then again, thanks for joining me, everybody. 312-277-0110. I'm on Twitter, Facebook, or shoot me an email. And until next week, everybody, have a great weekend, and I'll be back with you as price action develops. Take care, everyone.